There's a terrific story out of IB Times written by David Sirota and Avi Asher Shapiro. They did a wonderful job with this. So here's what they looked into. They looked into two different studies. And one was on, hey, do insiders actually have more information, Wall Street insiders, do they have more information on some of the stocks that they're getting from government sources perhaps? And did the insiders know the crash was going to happen before 2008? Now, if you ask, again, the mainstream media and the elites, they say, oh, no, nobody could have known. In fact, the best example of that is Robert Rubin. No one has been a more famous participant in the revolving doors inside Treasury Secretary for Clinton, used to be the head of Goldman Sachs, then moved to Citigroup, was on their board. And at the time, when asked about the mortgage crisis and the collapse in 2008, he said, quote, nobody was prepared for this. Now, it turns out when you look into the numbers, no, they were so prepared, they were already trading based on it before the crash. He went on to say, what came together was not only a cyclical undervaluing of risk, but also a housing bubble and a AAA ratings were misguided. There was virtually nobody who saw that low probability event as a possibility, except, as it turns out, the people at those banks. They saw it as a possibility, they traded on that possibility, and they made money off of that. So the researchers, there's 3 different international universities that worked on this, researchers tested that storyline against the SEC disclosures of the top executives' stock trades at 170 companies. That survey found a connection between bank executives selling their own personal company holdings and the performance of their firms in the crisis. The connection was particularly intense at firms with high exposure to the housing investments that fueled the crisis. So not only did they see it coming, but the ones that were most involved in causing the housing crisis were the ones that most heavily traded against the housing market. They caused the crash, and then they made money because they knew it was going to crash. But yet, when you ask the elites, they say, oh, nobody could have seen it coming. Nobody could have seen it coming. And then the Republican and Democratic politicians back them as if that has any validity. But when you actually study how they actually traded at the time, you see that they, of course, saw it coming and made money off of it. Now, the researchers explain, many defenders of finance in the recent crisis suggest that the giant institutions were really taken by surprise when the bubble popped. Our results suggest that insiders understood the heavy risk-taking in their banks. They were not simply over-optimistic, and hence they sold more of their own shares before the crisis. No, they were not taken aback. They saw it coming. Now, the regular everyday investor who got killed, they weren't privy to that information. They didn't cause the crash. They were the victims of that crash. Did we ever go after those bankers? You know what the answer is. Nope. Never went after them. Never prosecuted them. Just went along with the same storyline. Nobody could have seen it coming. The Bush administration, the Obama administration, both covered up for those same bankers. Now, there's a second research study that they talk about. And the researchers range from University of Colorado in this case, Stanford University, University of Navarra, and the University of Pennsylvania. Okay, so what did this study do? The study zeroed in on those who made trades after the announcement of the government's $700 billion troubled asset relief program, which bought up so-called toxic assets, mortgages and securities that had plummeted in value. So let me break this down further because this is amazing. Now, as these Wall Street traders are building the housing bubble, they're making money on the way up because all the commissions, all the trades, all the et cetera, they're all going up, okay? Now, at that point, you're going along for the ride. You're also going up if you got money in the stock market. But before it crashes, as the earlier study pointed out, they get the hell out, and then when it crashes, they make money. Now, you didn't make money, or you lost all your money in that. We lost 8 million jobs on top of all the money lost in the stock market, and mutual funds, and your pensions, et cetera. Now, this third part is, now some insiders get wind from their friends in the government that, oh, they're going to take those toxic assets that are worth nothing, they're going to pay, you get $700 billion in government money to pay for those assets. So those assets are going to go back up. So before they go back up, these guys jump back in when they're quote-unquote undervalued. So let's find out what happened then. Crunching data from 7,300 corporate officers at 497 financial firms eligible to get cash from TARP, the researchers found political connections paid off big time. Politically connected insiders had an information advantage during the crisis and traded to exploit this advantage. And one of the researchers from the Wharton School, Daniel Taylor, says, we looked at bank boards, he said, who had a director or officer who had work experience, current or past, at a bank regulatory agency, the Senate, or the House. And we found that the boards of those banks that had those political connections traded more heavily during the financial crisis. Now, at that point, everybody's panicked. There's not a lot of trading going on. These guys jump in, and they traded actually 3 times the rate of everyone else. Now, that's already suspicious, but wait a minute. They could trade and lose money, did they? No. Turns out the politically connected saw between 4 to 5% return in just 3 days. Now, to give you context, if you're not a trader or you're not an investor, 4 to 5% return is not a bad return for a whole year. Could be better, could be worse. You know, you walk out with a 5% return for the year, you think, okay, I can live with it. They got that in 3 days. Somehow, those guys connected to the government got some sort of information, and they don't, in this case, they're looking at macro numbers here. They're saying, okay, these are the politically unconnected firms. They don't trade that much, and they don't make money. So the regular investor, not worth looking at. You don't have any information, and you get screwed in this. But the politically connected firms, all of a sudden they start trading like crazy, and just within 3 days, they make 4 to 5% return already, immediately, like that. I wonder if they had extra information from their friends in the government, while the government was telling us, oh, no, this is private information. We would not share this with anyone, certainly not our donors who give us millions of dollars in campaign contributions and who will later hire us for $1 million jobs. No, we would never give them that information. Except as we conclude here with the International Business Times, in other words, while the government was supposedly deciding in private who would get TARP funding, politically connected individuals traded as if they already knew the outcomes of those decisions before the decisions were made public. And right there, everybody, is corruption in America. So when your standard greasy politician tells you that they went to Wall Street and told them to cut it out, laugh along with me. When they say no one could have seen it coming, laugh along with me. When they say, what corruption? You can't prove corruption. Laugh along with me. But more important than laughing is fight along with me. wolf-pac.com. We get the 28th Amendment, we get money out of politics, we get free and fair elections, and we end this corruption. You and I can do it together. Let's do it. wolf-pac.com.